it's all been the same story we saw again last year. It was exactly 1 year ago in August of last year that the Fed balance sheet bottomed, if you can call it a bottom, because they had reduced their balance sheet slightly. It was down to $3.7 trillion. Now it's at $7 trillion. Basically, and just to put this in perspective, the amount of money the Fed has put into markets equates to nearly $10,000 per U.S. citizen. It's an unbelievable amount of money. And put that in context with, Congress struggling about or haggling about $600 unemployment benefits. The wealth inequality was made greater again. And so, yes, everything has pumped into these stock markets, and we're back to the February highs. They were expensive in February because, from my perspective, that was a bubble then, and we had to crash. And now being back at the same levels, they're even more expensive than they've actually ever been. So we have forward multiples on the S&P that are similar to where they were in 2000. We have market cap to GDP at 176%, never ever seen before. So this market is not forward-looking, it's just chasing liquidity, and it's done so perfectly at this stage. And in a linear fashion, there has barely been hardly any correction. We had a little wobble in June, but that was about it. So from my perspective, markets are extremely overpriced and at risk. At some point, we're going to get some sort of volatility spike again.
Yeah, I mean, and you can hate this market. Every point people make, valuations, the narrowness of the rise, the ETF impact. I mean, you can hate this market. We talked to so many financial advisors, Sven. Their clients are at record cash levels. They don't understand it. But wow, listen, you're a chartist. I mean, the trend appears to be your friend here. I mean, is there any reason to avoid equities?
Brian, the very same thing could have been said in February. The very same thing could have been said in September 2018. The trend is your friend until it's not. And you look at these tops that we've had over the last couple of years, they all had kind of the same characteristic, and that is weakening internals, narrowing of the leadership. Yesterday, for example, we had on the NASDAQ, which was near all-time highs again, we only had 59 new highs, new lows. It's extremely weak underneath. You put that in context of the asset manager index, which is over 100, which means pretty much everybody's levered long here from the asset manager perspective, and put call ratios have completely dropped. There is complete faith in the Fed and the liquidity and more stimulus coming and nothing burning down. I mean, that's kind of the setting that you get. And then if you look at the VIX specifically, which has been in a compression mode ever since the peak in March, it's narrowing its banding in as well. And from my perspective right now, the risk is for the gap that was open in February, that could still fill is between 17.5 and 20. That's, to me, kind of the upside risk here for markets, that gap fills on the VIX. But it looks compressed, and it could break out at any time. And I got a target 45 to 46 on the VIX, which would indicate another volatility spike, obviously. And then the question is that a buyable dip if that happens, or then we're looking, depending on where this comes from, because there's always a risk we make a double top in the charts, right? So we'll see. I mean, for now, central banks remain in complete control, but if we drop below 3,200, things may change.